reporting season was the dominant theme from this week. So to keep it going, I thought we'd pick Baby Bunting as the stock of the day today. Jun Bei, the market has not treated this one very kind, even though we saw net PAT up 35%, driven by a pop in shares, fully franked dividend of 8.3 cents per share. The CEO saying that it was a tremendous year. So Jun Bei, the selling that we're seeing today on this Friday, does it come down to that lack of guidance, or is it a function of just the great run that Baby Bunting has had?
Look, it comes down to the great run. At this point, the market is really looking for a company, what they that's going to grow over the next 12 months or 12 months or 2 years. For Baby Bunting, it's kind of it's always belonged to that essential services space. So its earnings didn't really quite get hurt as much as other retailers and the like. And it does have some of the stronger comps to now cycle. Reported some of the negative comps, trading comps at the moment. So it certainly makes market less comfortable in terms of the growth for the next 12 to 24 months. Now, this business is well positioned given the baby boom we've seen in the last 12 months and the next few years, but it's just it's going to start cycling some of the strong numbers. And at this point, market is just not sure how far it's going to fall in terms of the earnings before we revisit again, for the rebase earning to grow again.
And would you be interested in this company on a more significant pullback, or has its time, come and gone for you, Jun Bei?
Oh, look, absolutely. Look, this is this industry actually has gone through a significant amount of consolidation and rationalization. Previously had a lot of competition, and then the previous competitors all sort of didn't quite survive. And leaves Baby Bunting has really strong scale and also geographical presence. And in the environment where the birth number does look like it will be pretty good for quite some time, and this business will benefit over the next few years. It's just for the time being. Near-term earning might be a little bit disrupted, just didn't look, in terms of growth, doesn't look as, exciting as some other business will be growing over the next few years. But I think it's absolutely a business that you want to buy back into once they experience significant sell-off.
Okay, hold. I'm going to call that a hold for now if you're in it, but it's not a buy today. Is that fair, Jun Bei?
That's right.
Okay. Claude, a rollout in New Zealand is what also steals a lot of the focus around Baby Bunting. There is execution risk. I mean, we're feeling it right now with the travel bubble over and the lockdowns in New Zealand, low vaccination rates in New Zealand as well. So is that a risk that you would prefer to stay away from, watch how the store rollout in New Zealand will go before you'd buy a company like this?
That is definitely a risk to be aware of. That's probably not what would concern me so much or what would keep me away. I think for somebody that doesn't invest in a lot of retail stocks, I've looked a lot at this one and talked a lot about it. Basically, just to restate, for the people just coming to this name or just thinking about the first time, the reason that Baby Bunting is a really interesting and good retailer is, first of all, like a few years ago, a bunch of its competitors went out of business. Second of all, it's sort of possible to make more of a moat for yourself when you're in retailing for baby for two reasons. First of all, one, the market will bear higher margins. Brand is extra important when people are thinking about what car seat they want to get or what pram they want to get, the safest one. There's something atavistic and evolutionary about how much we usually care about our children. And so they can exploit that to get higher margins, and you've seen that with the gross profit up 18%. So that's despite the fact that they have had some weakness, some same-store sales more recently has been going down, weaker. So basically what I've been saying about this stock for a while now is that it's a really high-quality retailer, but it is priced as such. Like, based on the current earnings per share that they just did, that's a 40 times earnings multiple. Now, if you want, you can say, oh, take out this, take out that, because it doesn't count and it's not their pro forma earnings. But if you want to just take a harsher view of it and just look at the statutory earnings, then it looks pretty expensive to me. And it deserves to be expensive, but where's your upside? Where's your upside if you're buying a good quality retailer on a high multiple? Like, you can get decent quality retailers that aren't that much worse than Baby Bunting for like half the price to earnings multiple. So I think that's your major risk with Baby Bunting right now. It's just priced reasonably high, and if anything goes wrong, it'll therefore be punished extremely badly. But if everything goes right, then it might just creep up a little bit, because that's what the market's already expecting. So yeah, the risk reward doesn't stack up for me.
So it's a hold if you've got it?
I hold it best. Yeah. Like,
Okay.
I don't tend to be a long-term buy and hold investor in retailers, because it's very hard to find a retailer that keeps on winning for like decades. But, I guess Solly Lou sometimes does it. Breville's pretty good. There's a few that have done it.
Yeah, Breville reports next week. JB Hi-Fi reports next week as well. So looking forward to that.